Hello everyone, good afternoon, good morning, wherever you are. Welcome to the Mayar quarterly Q&A as we look back at Q4 of 2021 and perhaps all of 2021. As a reminder, this session is generated and for you, the audience. So questions always gratefully received. We have received some questions ahead of the meeting and the presentation that you see you saw on screen when you joined. We'll have a few slides for you to go over some of the questions, but you're also able to post questions anonymously on the live event Q&A. We won't be able to, I'll be able to see your name, but the other attendees will not. But if you want even further anonymity, then you can check the anonymous box and you can ask your question with total anonymity if that's what you prefer. The session is due to finish at 3 p.m, but if we finish before that, we're happy to give you back the time in the day. We're joined by Aziz, the portfolio manager of the Mayar Fund, and senior research analyst Aubrey Brocklebank that will be available to answer your questions. So the first set of questions that we had actually covered performance, asking us to comment on what was a period of underperformance for the fund versus the benchmark in 2021, and also dig deeper into how the broader peer group has done. And the rather colourful slide that you can all hopefully see at the moment is our attempt to detail some of that. Just a description of the data that you see. We've chosen what we regard as the best-in-class peer group in our category, which is large cap global equity blend. We've also added a Schroeder fund, which is a more traditional approach to value investing. Also included on the slide in blue is the MSCI World Benchmark, and then in grey, the broader peer group return, or the average peer group return for the periods in question. You'll see from that dotted line, that's where the peer group average is. So hopefully that's some evidence that we've selected what we regard to be the better performance in that peer group over time. And we've done it not only for 2021, but we've looked back over 2020 all the way up to last night's close. And the reason for that is we think that the pandemic period from the end of 2019 all the way up to last night's close is to some way a microcosm of market movements. If we remember back to Q1 of 2020, we had a big sell-off followed by a sharp recovery. That recovery continued throughout 2021, and as we have begun 2022, we've seen another sharp sell-off, this time perhaps not directly related to the pandemic, but other events as well. And I think one of the things that we can see from this is that over that longer term, Mayar is in amongst the better performers, even within the best performers of that peer group. And in certain years, 2020, the notable of this select group, Mayar is the best performer. But I think it can show the danger of looking at short-term performance periods in isolation, which shows that some of the best performers over longer term inevitably have shorter periods when they're not outperforming the market. And I think that should be expected. Aziz, I don't know if you've any comments around that performance profile to add a bit more colour to that. I think we've got enough colour, but if you could add some more,
yes,
that would be great.
Thank you for that, Mark. So I think that one of the things to highlight here is we've deliberately chosen in presenting these four periods the best of the class that we think we belong to, and you can see that by just where they've performed over most of these periods relative to the median, and the difference here is quite massive. Even if the graphs look like they're similar, you can see that the difference between 23 as the peer group, 23% since the beginning of the pandemic, and 32% or 30% for the benchmark. It's quite a big difference, and if you compound that over long periods of time, then you end up. So one of the things to remind everyone is everyone that we've selected here has outperformed the benchmark over long periods of time. So even those who look like they've underperformed since the beginning of the pandemic actually do have quite a long track record of outperforming the benchmark. And I think what this highlights is it's a reminder that, and you can see how the colors change from graph to graph. It's the reminder that in any one year, any one fund's ranking can be either at the bottom or the top. We being the prime example of the top two, where we were basically the best in 2020, and then in 2021 we were just short of the second worst in this peer group, or these selected names in peer group. There are a lot of other ones that have done worse than us, but in any one year. And the point is, measuring performance for a concentrated strategy such as ours and such as the ones here cannot be done over 1 year or 2 years or 2.5 years, to be frank, because the short-term volatility in relative performance especially is going to be all over the place. And the reason is, you're looking at a benchmark of 3,000 names and comparing it to portfolios that got 20, 30 names. You will have big differentials. The other thing that with all of these peer groups, and especially us, not only do we have a smaller portfolio, you've got a very different exposure in terms of industry mix, in terms of geographic mix relative to the benchmark. And so you do need to look at it over a much longer period of time to be able to see whether these, even if you own, it's not just an issue of selecting individual names, but also selecting industries and geographies. What's the impact over long periods of time? And that's essentially is the cost of having high active share as a portfolio. And we've talked about high active share in the past a lot. The downside of it is that your performance over any one day, month, quarter, year, 2 years is going to be all over the place. And so whether we do better or do worse in any short period, we've said that in 2020, doesn't really mean anything. It's, from all intents and purposes, a year or two is just noise for anyone following these types of investment strategies.
One of the things that you mentioned in this letter and other letters as well is the phrase that how the short-term market is a voting machine, in the long term it's a weighing machine. Could you explain that phrase in a little bit more depth, because I think it's relevant to the charts that we see here?
Yeah, so the quote is attributable to Ben Graham, father of value investing, and the idea is if you look at every day, you go and you look at the price of the stock in the market. This is what market participants who have decided to actually engage in buying and selling on that day, and happen to either want to buy or sell that stock on that day, have decided this stock is worth on that day. So essentially, it's a collection of votes from buyers and sellers on that day, that based on where they think. And so the effective supply and demand on that day, the liquidity of that day, whether the long-term holders are many or few, all of these factors play a huge role in determining the price of the stock in one day. And the reason is everyone is more or less guessing what the stock is worth with different degrees of quality guesstimates, in a sense. And however, over long periods of time, these guesstimates over, say, the next 5 years translate into the actual outcome over the next 5 years. And if the reality is very different from the guesstimates made at the time, the stock will adjust upward or downward as the reality unfolds. And obviously, people at that end point will start guesstimating the future from there onward. And so the actual outcome of an investment over a multi-year period is going to depend on how the business performs over that period. It's not going to depend on what everyone thinks the business is going to do. But if you look at it over any short period of time, the impact of sentiment on these future estimates is going to be disproportionately large. And so essentially, if you want to invest for the long term, the quality of your decisions and the outcome of your decisions will be determined, whether you like it or not, by how these businesses that you've chosen to invest in will perform in the future. And so hence the focus that we have on understanding the businesses, coming up with better forecasts, doing a better job of measuring evaluation, et cetera, Whereas someone who's investing for a week or a month or frankly for a year, for all intents and purposes, understanding the business on the moat is almost irrelevant because there are way more factors, the voting factors, the sentiment, that's going to determine the outcome than the actual performance of the companies.
Okay, thank you for that. I think that covers that particular question. The second question that we received relates to a specific stock example in the portfolio, namely Mastercard. Some of the more high-profile short and hedge fund managers have short positions in Mastercard, and I wondered if you could make some comments on Mastercard. Now, I know you can because we have prepared a slide on it that you can see on.
Well, I'm
screen.
gonna let Aubrey take that first, but I do want to highlight that we actually own both Mastercard and Visa, and actually our position in Visa is bigger, so we should really be commenting on both of them. Aubrey, do you wanna start?
Yeah, well, let me preface this, by saying, look, one of the reasons that we look into high quality businesses and we look into businesses that have these large economic moats is that these moats will protect these businesses from disruptors. Every business is potentially able to be disrupted, but that's why you try and look at high quality businesses. Now Mastercard, I think is a great example. Mastercard, I think, is a great example of a high quality business with a defensible moat. And yes, we are now seeing potential disruptors, but actually Mastercard has faced disruptors for a long period of time. I remember maybe 6-7 years ago meeting a company called Seamless that believed that they were going to, actually the CEO, Peter Fradel, he told us in a meeting that he was going to displace Visa and Mastercards by using QR codes. And I think that business has, we haven't seen much QR codes being used for payments. And now we have DeFi and we have buy now, pay later. And we can see here, Klarna, the massive buy now, pay later firm, are launching a physical card with Mastercard. I think the thing is, as the tweet from Buco Capital actually is showing, for a lot of these disruptors, especially when you're playing against Mastercard and Visa, it's really just marketing, because Visa and Mastercard have the rails, they have the infrastructure, and why compete when you can actually just use them? And effectively, in many ways, they are just another form of marketing the model. Perhaps another thing I might just sort of share with you is, when I was unfortunately shorting Sage back at my old firm, and we were doing that on the basis of Zero taking huge amounts of market share. But here's the thing, when you've got a growing market and you go from a 2% market share to a 5% market share, it doesn't actually make a huge difference to the incumbents. And we're not even at that position with some of these disruptors who are trying to, Mastercard. So look, it's something that we're watching, sure, but we're not yet worried.
Yeah, I think I would add that first is to emphasize that we're, like you said, we are watching this. We're not dismissing this. Every business that we own, no matter how strong the competitive advantage or the moat, is at risk of disruption. And actually, nobody wants to disrupt a shitty business. So it's when you own a high quality business, you're always kind of trying to defend your business, hence the need for a moat. I mean, one of the most important things to remember about these quality businesses is people always talk about a moat, but actually a moat is only worth it if you're defending something worth defending. So the best run quality businesses are the ones where management is continuously deepening the moat, widening the moat, adding water and crocodiles and whatever it is to defend the castle. And we think that Visa and Mastercard continuously do that. It doesn't mean that it won't be attacked. It will be attacked by definition because they're great businesses worth disrupting. But we think that so far they've shown us that their ability to defend the business from attackers has been fairly robust. We always look at it, but we at the same time appreciate something. So one of the strengths of Visa and Mastercard, I would argue, that are least appreciated. Everyone knows the value that comes from the ubiquity of the merchant acceptance for Visa and Mastercard. But the other side of it, I think that is often forgotten, is how much value they create for the whole ecosystem, including the issuers. So the issuers, people talk about Mastercard and Visa fees and say, oh, well, they're charging all these high fees. Well, almost all of these fees are going to the banks that issue the card. So in a sense, the providers of capital to fund these purchases are the banks, and they're getting the biggest benefit from it. And we've seen that in places where these are regulated down, it's just a redistributed the pie between the banks and the consumers in a sense, because consumers get back a lot of that benefit in the form of rewards and free credit card annual subscriptions. And when that was regulated down, you just ended up, the issuers have to earn a return on their capital, and so they either lower the rewards or increase annual fees or both. Now one can come and say, well, what if the banks are disrupting? And I think what buy now, pay later providers like Klarna, Exhibit A being them issuing a credit card with Visa, are trying to do is essentially disrupt the banks, but not Visa and Mastercard. So they're still using the rails, they're issuing the card, but at the back end of it, the capital is coming from them as opposed to from a bank. And my view is, if it turns out to be that is the end game, then I think the buy now, pay later providers are in a lot of trouble. And the reason is their cost of capital cannot be cheaper than the cost of capital of a bank. Just the way banks operate through all the massive deposits that they get, that's guaranteed by governments, they have the absolute lowest cost of capital of anyone in the economy. And so a lot of this money that buy now, pay later providers are lending to consumers is coming from equity holders right now. So the cost of capital is exceptionally high. They're not earning anything on it. At some point, that has to stop, either because the free money stops, which could happen any day, or as you exhaust that venture capital money that's willing to wait with you for 5-10 years or whatever, it limits your ability to grow, because then you need to start paying for that capital. And once you do, then you have to pay the providers of that capital in order to use their capital to lend it to consumer. And who's going to pay the cost? So the consumer is going to have to pay interest on this buy now, pay later loan. There's no way to have a free lunch where you just get free money as a consumer and not pay for it. Or the merchant is going to pay for it, or a combination of both. So in the end, I mean, the idea of buy now, pay later is not new. I mean, merchants, shops, and department stores for literally hundreds of years have been giving credit to their customers. Historically, they've been doing it by having a higher margin on the product that they sell, knowing that the neighbor down the street may not pay their bills on time, et cetera, et cetera. So it's not a new concept. The difference is, how does it get delivered? And what we've seen so far, it gets delivered either through the existing rails or through alternative means that are direct. But even if they go direct, someone still has to pay the cost of that capital. So I don't see how specifically buy now, pay later are such a big disruptor to how this works. For one, Visa and Mastercard have had buy now, pay later in many geographies for many years. They and now there's more demand for it, so the take-up rate is higher. I'm honestly more worried about other things that try to circumvent their rails as opposed to circumvent their consumer-facing aspect of Visa and Mastercard. But again, I think that's also an underappreciated thing. The Visa and Mastercard network have proven to be the most robust networks that we have in terms of redundancy and speed. We actually have very few things that run as efficiency as them, at cheap of an energy cost as them, and as cheap as a delivery source as them. So, but if I wanted to pick the area that I'm worried more about the most, I would say it's the plumbing of the network that I think would be the most vulnerable part as opposed to the consumer facing.
And yes, there are plenty of Web 3.0 applications that may, blockchain applications that may at some point, but the trouble is, and this goes back to what I was saying, their market share, their adoption rate is so small at the moment that it's just not meaningful to Visa and Mastercard yet. And they can get to quite a big market share before it actually impacts on Visa and Mastercard. So we watch these things carefully, and this is the point, we can watch them, and it's not being complacent, it's just saying, look, they have to get to a certain point before we're going to actually, get upset and let go of one of our top holdings or one of our best businesses.
Yeah, and then the other thing is I think frankly, this applies to other businesses that we own, if you eliminated all these potential risks, the stock should be worth 2, 3, 4x what they trade at. So it's part of what we do is understand the risk and price it into what we do.
Okay, thank you for that. We also had some question about another aspect of the portfolio, namely the cash position. You've often said that the cash position reflects the view of future opportunities relative to current opportunities. Yeah. But given the market was quite strong last year and we had cash balance on average of around 10%, I think. Have you thought any more about deploying cash or putting that to work?
Can you pull that comparative performance slide?
Okay.
So while this comes up, listen, any period where the market goes up, whichever period you choose to highlight, if you've had any cash during that period, it's a drag. I mean, by definition, it would have hurt you during that period. Historically, having cash has been useful to us because it gave us the opportunity to take advantage of sell-offs and put money to work fairly quickly. It also gave us the ability to have the discipline of making decisions about buying and selling independent of cash. If we had the policy that we had to always be fully invested, we'd end up having to hold on names that we may not want to hold on to because we have nowhere else to put the money to. So in a perfect world, we don't want to hold cash, but when we cannot find opportunities that meet our criteria, we've got no choice but to stick to the discipline of holding cash for some periods of time. Now, over the past 2 years, we held an average of 10.8% and time-weighted average cash over those 24 months. At the bottom of the pandemic, we almost held zero cash. I think we got to 1.7% or something like that. We would have deployed the rest had the market not recovered so quickly. So we're not holding on to the cash because we want to hold on to the cash. And in that period, in early 2020, we did go from a 20-something, 21, 22% cash position to almost zero, like I said, in a span of 2 weeks. So we we can and do have a history of acting quickly in deploying cash when the opportunities arise. But with the benefit of hindsight, obviously, over the past year and a half, we sold some names too early. They exceeded what we thought they were worth, so we exited. Everything else was up, so we didn't deploy that cash at the time. We ended up with more cash. In fact, if you take our performance, add in the cash drag, it would put us on par with the performance of the highest performer in our peer group, Fund Smith, where they're fully deployed. So had we had stayed fully invested, we would have matched the performance of Fund Smith. We didn't. But hindsight is 2020, and I think we were, in retrospect, too conservative in how well we thought the economy would do, but also too conservative with valuation. And the downside of that is when you have a super strong year like 2021, that will really hurt us. The flip side of it is when you have a year like 2022, you see the bottom left chart there. Look at what our portfolio did month to date, and look at what Fund Smiths and the benchmark portfolio have done. So you got this massive advantage in being conservative. Of course, what's the expression? One sorrow does not a summer make, or something like that. Just, it is still 1 month. It is still January, so it's no time to celebrate 2022. But this is not because of cash. Our cash is actually now less than 10%. It is because we were conservative in what we owned and how much we owned. There is, again, this is part of these short-term measurement issues. If the market had looked like what it did 2022 for the full year, our cash would have helped us, and we would have been declared geniuses for holding cash. But yeah, like, I mean, again, a reminder that we don't like make a portfolio bet that says, oh, we're going to hold cash because we want to bet or time the market. The reality is it is the organic outcome of our buying and selling based on what we like and don't like, and how we either build up or cut down our positions.
Okay, thank you for that. We have one final question that we can address. If you do have any further questions, please feel free to contact any one of the team, and we can address them directly. We have received some questions earlier today that I will come back to you directly on those. One final one, though, is can you shed light on the 2022 outlook? I guess one of the things that we don't do is make decisions over these short amounts of time, but there are, I guess, as we come out of the pandemic into whatever the new normal is, there are issues that are inflation, for instance, rate rises that, although they may happen in 2022, may have longer term implications. So it'd be useful to know how you're thinking about some of those longer term dynamics at play at the moment.
Well, I think the first thing is anyone who, my opinion, and I've said this many times, I'll reiterate it, anyone who gives you a prediction of what the market is going to do in 2022 is either lying to you or lying to themselves. There is absolutely no doubt in my mind that it cannot be done. No one knows what the market is going to do over 12 months. It's absolutely outside the norm of what is knowable. I mean, you could argue that some people can make some bets at extremes, and I would agree with that. But on most years, when the market is in like absolutely ridiculously, Siri disagrees with me, apparently, but unless you're at extremes like the bottom of March 2020, no one knows what's going to happen in the short term. The other thing is, I suspect that the things that are knowable in the short term, economically or geopolitically, are more than the likelihood of you being able to predict these things is higher than your ability to predict their impact on the market. So you may still guess correctly what's going to happen in Ukraine or what's going to happen to inflation or interest rates. That does not mean that you also will know how the market is going to react to that. I mean, 2020 is a perfect example. I mean, just look at what happened in 2020 to the world and what happened to the stock market. It's mind-boggling. These things happens all the time. So this is why we don't make 1-year predictions. The reality is we don't know. And so why should we engage in an activity where it's frivolous? And the other reason we don't do it is we're actually making investment decisions for the next 5+ years. We hope that most people invest with a horizon that's even longer than that, and would be wasting time and effort trying to predict a few months, even if we could do it, if they had no impact on what happens over the next 5 years. We do look at macro events, we do look at geopolitical events, we do look at all these things when we're looking at our companies and how they impact our companies. But we don't do it at a macro level to decide what to do for the portfolio just in abstract. I don't know, Aubrey, do you?
Well, obviously we don't want to predict stuff, but there is a lot of volatility happening at the moment. There is a lot of geopolitical risk, and if that gives us more volatility, for us that's a good thing. If stock prices fall, for us that actually is a good thing. One of the problems when stock prices go up is it's really hard to buy stuff as a value investor. When stuff goes down, then we have opportunities to make your money. So I'm not going to make a prediction, but I will say I would like to see more volatility. I would like to see, I'd like to see more opportunities that we can act on. And I think that, there is a good chance that happens this year. Certainly with what we're seeing, but who knows? Yeah, we're getting ready to act for it.
Yeah. Well, I think historically we've done better with volatility, as do most stock pickers. They should. Because honestly, if we all knew that the market is going to go in a straight line up, just buy the ETF and go to the beach. Why come get up in the morning and come over here? It's wasting everyone's time.
Okay, well, in the absence of any further questions, or if you do have any questions, please feel free to contact me or any one of the team and we'll get back to you directly. For now, that is the end of the Q&A, so just allow me to thank you for attending. And if you want to hear this again, we'll have a podcast version and the YouTube version and a version up on our website as well, so you can relive the last half an hour should you wish to. But for now, that's goodbye from us. Goodbye.